Hello everyone, my name is Hitesh and I welcome you all in our next chapter of futures learning. Now, in the previous three chapters, we have learned the concept of forwards agreement, futures agreement, and how is futures agreement trading different from the spot market trading. Now, in this chapter, we'll be understanding the concept of margin because the whole premise of future trading is based on the simple concept of margin and what are the various components of margin. So, let us jump right into our discussion for the same. So, before we understand the implications of futures trading and the impact of margin on it, let us try and understand what exactly are margins. So to put the things into perspective, margin basically gives you the capacity of buy or sell more than what your initial capital would allow. If you would remember in the discussion of previous chapter, to buy 750 shares of Reliance Industries in the cash market, we had to shed out nearly 5 lakh rupees. But to express the same view in the futures market, we had to give margin of only about 1,20,000 rupees. So margin gives you the power of leverage. It basically lets you to be a part of a trading game which is slightly more out of reach right now, but because of the factor of the margin, you can still be a part of it and enjoy the benefits which come out of it. And in the world of stock markets, margin trading allows you to buy or sell more shares of the underlying stock than what you could with the initial capital which you had in your trading account. Supposedly, if there are shares of say 100 rupees per share and you have only 10,000 rupees in your trading account, so in the spot market you'll be able to buy only 100 shares of it. But with the power of leverage and margin trading, you might be allowed to trade up to maybe 300 to 400 shares of the same company and get more reward if the share price move in your favor. So that is the power of margin. And on the flip side, the negative side is that if the market goes against your view, you could be losing money which is equivalent to the share price of 300 to 400 shares. So it does come with its own risk, but the chances of getting reward also goes higher with it. Now the next point of contention is, why do we need to charge margin? Why does the stock market or the brokers need to keep margin with them while trading futures contract? Let us try and understand with the help of a simple example. Say there are two traders, there is trader A and trader B. Now trader A here has a very bullish stance on the share price of ICICI Bank. He is seeing a strong momentum in the share price and is expecting the momentum to continue for the days to come. While trader B on the other side has a bearish stance on the shares of ICICI Bank. He feels that the market is nearing resistance and the share price of ICICI Bank is overcooked and it is due for a technical correction of 4 to 5% from its current value. So how could they express their view? The simple way is to enter trade with each other. So let us try and understand the first form of trading, that is through forward market. How would they express their view? Basically, they'll get into agreement to buy a specified quantity at a pre-decided price in future, and there's no third party involved in the agreement. If you remember our discussion in the chapter 1, we have told you that it's forwards are OTC agreement and there is no exchange or there's no third party involved in the transaction. It is the mutual agreement between both the parties involved in the agreement. And the problem which happened with that was the problem of legality risk. Because there was no third party or because there was no government body, it was sometimes easier for parties to default on their payment and they would not pay up the second party because they made losses and there is no legal standing in between them. Although you could go through a legal route, but we all know what is the procedure and how long is the procedure for that. So how does the default happen here? Say the share price of ICICI Bank comes down. Then trader A might not agree to honor the agreement. He might say that I'm not going to honor the agreement I have, and he is likely to default. And if the share price of say ICICI Bank goes up, then the trader B might also say the same thing, that I am not going to honor the agreement which we had, and he is on the verge of default. So these issues crop up with the concept of forward market. So which is where the concept of margin comes into picture. Let us understand how. The other way to express the same view on ICICI Bank by both the traders is through futures trade. As we all know, the future trades are regulated by an exchange. There's a margin involved. There's a proper legal structure and there's a proper framework and proper institution where these trades kind of take place. So margins are a very important factor while trading future agreements or future trades. All the trades for the future agreement are routed by a governing body. The governing body in India is SEBI, that is the Security and Exchange Board of India. They are the one who are the governing forces while doing the fact check on a futures agreement or future trades. And how does the exchange here solve the problem of forward market? If you remember carefully, the major difference between the forward and the future contract was the availability of a mediator in case of future trade, which was in the forward trades, and also the availability of margin which is charged while trading futures agreement, which wasn't the case with forwards agreement. And so basically what do the exchange do is they basically collect margins from both the parties involved. Say both A and B want to enter into agreement of, say, ICICI Bank. So just before entering the trade only, they have to keep certain amount of money as a margin in their trading account, which is used to safeguard the interest of the exchange and the other parties, just in case the losing party doesn't want to just oblige with the agreement which they entered into. And the exchange also marks daily profits and losses, that is mark to market, even though the agreement might go on for 8 to 10 days, but at the end of each and every day, the profit and loss are marked to market on the basis of the performance of the underlying asset. Now, there are basically two kinds of margin. The first is the span margin and the second is the exposure margin. So basically, span margin is the minimum requisite margin required in the trading account, and the exposure margin is the amount which is required more than the amount of span margin. So span margin are basically mandated by the exchange. That's the minimum amount of money which you have to keep with the exchange. And the exposure margin, which is the amount of money which is kept by the broker in the trading account to account for mark-to-market losses. So these are two different kind of margin. One important factor to consider here is this: if the amount of span margin is not kept in the trader's account, then the exchange holds the right to square off a position anytime which it intends to. So to be a part of the trade, it is very important to maintain a minimum amount of span margin in your trading account. Now, we have been talking about the concept of mark to market for quite some time. Let us try and understand what exactly is mark to market and how does it impact the trading. So M2M is basically an acronym for mark to market, and it is an adjustment of profit and loss of position carried over a period of time. Supposedly, if you are holding certain position for a period of 5 to 6 days, so you have a starting date and the ending date, and the difference between the two prices is basically your profit and loss. But at the end of each and every day, the share prices do move and the underlying asset price also moves. So from the initial price of entry to the closing price on that particular day, the profit and loss is adjusted, and that is a simple concept of mark to market. That is basically marking your position to the market price of the underlying asset. Let us understand the concept of M2M with the help of a simple example. Say on 5th of January 2020, we decided to buy one future lot of HDFC Bank. The lot size, that is the number of shares per contract of HDFC Bank in futures market, is 550 shares, and the current price of one share is 1,426. So, and the exit price for this trade is 1,448. So it's a clear signal that we made some certain money on this trade. We made about 22 rupees per share on this trade, and the total profit will be 550 share, because that is the number of shares per lot of futures trade, and 22 rupees per share. So that is a profit of 12,100 rupees per lot of futures contract is the profit made on this. So 12,100 is the amount of money which is made on one lot of futures trade. Now we have seen that the ending price and the beginning price, the difference between them is the profit or loss made. But during the duration of 3 days, the prices did move, and the closing price for each and every day was different. On the 5th January, the closing price was 1,438. On the 6th of January, the closing price was 1,432. On the 7th of January, the closing price was 1,442. And eventually we exited the trade on 8th of January. One important thing to note here is that the buy price for this future contract was 1,426. So let us mark to market our trade on day-to-day basis. The closing price is 1,438. The profit earned for the day on the basis of purchasing price will be 1,438 minus 1,426. That is the entry price. The difference between them is the profit of 12 rupees per share. So total profit on that contract for that one day mark to market will be 6,600 rupees. Let us understand the M2M on the 6th of January. Be careful, the M2M on the 6th of January is calculated on the basis of the closing price of 5th of January. Not the entry price, the closing price of 5th of January. The closing price of the futures on 6th January was 1,432. The profit earned on the basis of previous day closing price would be a loss of rupees 6 per share. And the total loss in this case for that second day will be minus 3,300. Similarly, for the third day, the profit on the basis of same calculation will be 5,500, and eventually on the day of exit, the profit for that particular day would be rupees 3,300. And now if we were to add up the profit and loss for all the 4 days, we actually get the amount of profit which was made initially, which we calculated 12,100. So this is a simple concept of mark to market, but it goes a long way in understanding how much money have you made for a particular day, and even exchange safeguard the interest of both the parties involved in the trade. Now, what are the key takeaways from this chapter? A margin payment is required as long as the future trade is active. As long as one wants to be a part of the particular trade, they have to maintain that margin money in their trading account. And the margin money is frozen at the time of entering the contract. So this is very important. As in, when you enter the contract, the amount of money is blocked in your trading account. You can't use that money for doing any other trades as long as you're part of this particular trade in the market. And the margin money is collected by the broker from both the parties. They basically, both the buyer and seller of futures trade will have to deposit margin money with the exchange and the broker. And the margin is collected, acts as a leverage, as it allows you to deposit a small amount of money and take exposure of large value transaction. Now we have to understand that the amount of margin money required is not the total value of the contract. It is only a part of it, and the part of it depends on the quality of the share and the liquidity with the share. Say for example, if you're trading indexes, then the amount of margin required is 10 to 12% of the index of the total contract value. But if you're trading shares of certain company, the margin varies between 20% to 60%, depending on the volatility and the movement in the shares. And profit and loss of the day is basically done adjusted on day-to-day basis, and it is even updated on the trading account on day-to-day basis. And if the margin money goes below the span money, which I have told is the amount of margin required, which is kept with the exchange, the investor must deposit the money, because if he doesn't do that, then the position will be automatically squared off by the broker. I hope this chapter gave you a brief understanding of the concept of margin, what are different kinds of margin, how does margin protect the interest of both buyers and sellers. In the next chapter, we'll be dealing with few more concepts regarding the future market. I hope to see you there. Thank you so much.